look at that chart. That long vertical line piercing through today's candle. Silver touched $78.12 per ounce this morning, the highest price in recorded history, before violently rejecting back down. If you're new to this market, your stomach probably just dropped. You're thinking the rally is over. But if you remember 1980 or the chaos of 2011, you know exactly what this is. This is a war. The candle forming right now is called a shooting star. Technical analysis says it signals a reversal. That buyers are exhausted and sellers are taking control. Textbooks call it the top. But here's what textbooks don't tell you. Context matters. A shooting star at the end of a dying trend is a funeral. A shooting star at the beginning of a breakout is just turbulence. What we're witnessing isn't an ending. It's an acceleration that got too fast, and the market tapped the brakes. Let's rewind. Silver opened this week around $70. That alone was insane. We started this year at $31 per ounce, a 169% gain in 12 months. If you told anyone in January that silver would push $80 by December, they would have laughed. But here we are. Every dip gets bought. Every resistance level gets demolished. Gold sits comfortably above $4,500, providing legitimacy under this entire move. The monetary system is broken, and everyone knows it. But silver isn't just a safe haven anymore. It's a supply crisis wrapped in a mania. Electric vehicles need it. Solar panels devour it. The tech industry can't function without it. And there simply isn't enough. Mining production has been flat for years. Easy deposits are gone. New mines take a decade to develop. Meanwhile, demand has exploded. Tesla uses millions of ounces annually. Samsung, Apple, every smartphone manufacturer needs silver for circuits. The AI boom makes it worse. Data centers require massive amounts for electrical systems. The math doesn't work. There's a deficit, and when you have a deficit in a small market with limited liquidity, prices don't just rise, they detonate. When silver touched $78 this morning, it wasn't random. It was inevitable. Too much demand chasing too little supply. But then something strange happened. Within minutes, the price collapsed, not slowly. It felt like someone cut the strings. Traders who bought at the top watched their positions bleed. Stop losses triggered in waves. Panic spread. By the time dust settled, silver traded for dollars lower. The shooting star was born. But here's where it gets interesting. Who are those sellers? Because the physical market didn't crash. Coin dealers didn't drop prices by for dollars. Many raised their premiums. When you called your local bullion shop today, they weren't begging you to buy at a discount. They charged yesterday's prices, maybe higher. American silver eagles, Canadian maples, bars and rounds. That investors actually hold none got cheaper. The disconnect between paper silver and physical silver just widened. The futures market, the derivatives, the leverage bets, that's what crashed. The metal itself stayed expensive. This tells you everything. This wasn't a real sell-off. This was a liquidation event. Someone was forced to sell. Maybe a hedge fund that got too greedy. Maybe a bank defending a critical price level. Or maybe a deliberate attack to shake out weak hands before the next leg up. There's a term for this: stop hunt. Big players know exactly where retail traders place protective orders. They know most people who bought at $75 set their stop loss at $70. So they engineer a drop. They dump a massive position all at once, driving price down fast enough to trigger those stops. Thousands of automatic sell orders fire simultaneously, creating a cascade. Price plummets, and the same institutions that caused the crash, they're waiting at the bottom, buying back everything at a discount. It's brutal, it's manipulative, but it's how these markets work. The game transfers wealth from the impatient to the patient, from the leveraged to the unleveraged, from tourists to institutions. If you panicked and sold today, you just paid tuition. But if you held, you survived. And in a bull market, survival is everything. December 26th, 2 days ago, the Chicago Mercantile Exchange announced they're raising margin requirements. Starting December 29th, Traders controlling silver futures need $25,000 per contract instead of the previous amount. That's massive. And if you know history, you know what this means. In 1980, when the Hunt brothers tried to corner silver and drove it to $50, the CME raised margins repeatedly until it collapsed. In 2011, when silver hit $49, they did it again. 5 margin increases in 9 days. Result, a 30% crash that ended the rally and crushed leveraged traders. So when the CME announced another hike, traders got spooked. Is this 2011 all over again? The fear is understandable. Margin increases force traders to either add cash or close positions. When everyone closes simultaneously, prices collapse. But here's the twist. This time might actually be different. In 1980, silver was a speculative bubble with no fundamental support. The Hunt brothers artificially manipulated the market. There was plenty of physical silver available. In 2011, the rally was fear-driven after the financial crisis, but no actual shortage existed. Supply could meet demand. But right now, December 2025, we have a legitimate supply deficit, not projected, not maybe, an actual, measurable shortage getting worse every month. China is hoarding. India's import demand is at records. Industrial users are scrambling to secure contracts before prices go higher. The silver mining industry has been underinvesting for over a decade. After the 2011 crash, when prices fell to $15, mining companies shut down projects. They stopped exploring. They cut budgets. Now, even at $78, you can't flip a switch and double production. Opening a new mine takes 8 to 10 years minimum. And here's the kicker. Shanghai silver is trading at a significant premium to COMEX. Physical metal in China costs more than paper contracts in Newark. That's not supposed to happen. When that gap appears, it signals one thing: shortage. Real, physical shortage. When you look at that shooting star, ask yourself what it really represents. The people who sold today were leveraged speculators. The ones using 5, 10, even 20 times leverage because they wanted to get rich in a week. When the margin call came, they had no choice. Sell or get liquidated. The people who bought at the lows, industrial users, procurement managers at Samsung, Tesla, every solar company saw the $4 drop and hit buy instantly. They don't care about chart patterns or shooting stars or technical analysis. They care about securing supply at the best price. To them, $74 look like a gift compared to $78. Every time the paper market crashes, the physical market absorbs the selling. The weakness gets converted into delivery requests. The shortage intensifies, and the next rally becomes more explosive because there's less metal available to suppress price. Last week, we celebrated $65. We thought that was incredible. Today, we're disappointed with $78. See what happened? Your perspective shifted. The wealth effect is playing tricks. You're frustrated you're not richer, faster, but you're still winning. If I told you a month ago silver would trade near $80 by year end, you would have called me delusional. The smart money isn't thinking about today's candle. They're thinking about January. That's when real money shows up. Pension funds, endowments, sovereign wealth funds don't trade during holidays. December is dead for institutional capital deployment. But come January, they rebalance portfolios. They allocate fresh capital. And what will they buy when they look at 2025 performance charts? Silver is up 169%, best performing asset class by a mile. When institutional allocators sit down in early January to deploy hundreds of billions, silver will be at the top of the list, not as speculation, as strategic allocation. We're to days from year end. Wednesday, December 31st, the monthly candle closes. The yearly candle closes. If silver finishes above $75, it prints the highest monthly close in history. That's a massive technical signal telling trend followers that the bear market is mathematically over. A new secular bull market has begun. and secular bull markets last years, sometimes decades. Think about this year. We started at $31, broke through $40, then $50. $1.60 felt impossible. $1.70 was a dream. Now we're casually trading near $80 and treating it normal. Each resistance level got crushed within weeks. The momentum is building. More people are paying attention to silver than any point since 2011. Mainstream media is starting to cover it. Financial advisors who ignored it for years are suddenly recommending positions. Awareness is spreading, and awareness creates demand. Demand in a shortage creates price explosions. First, audit your leverage. If today made you physically ill, you're too exposed. You have too much margin. Fix that. Sell some paper positions. Move into physical metal or fully paid mining shares. The volatility in January will make today look tame. Second, watch the $75 level. That's the line in sand. We bounced hard off $74 today. Confirming $75 is now the floor. As long as silver stays above that, the breakout is intact. If we test it again, it's a buying opportunity, not panic time. Third, ignore daily candles for the next 2 days. Volume will be pathetic. Algorithms will paint weird patterns. Don't torture yourself. Set a price alert and walk away. The market wants you to make impulsive decisions out of frustration. Don't play the game. Is the shooting star top or turbulence? History gives the answer. Every major bull market experiences violent shakeouts. The shooting star we saw today wasn't a reversal. It was a stress test. The market tested the resolve of every silver holder. People who sold answered the question. They weren't committed. They were tourists, and now they're gone. What's left? Industrial buyers who need silver to manufacture products. Central banks quietly accumulating precious metals. Stackers who've preached about this moment for years. Institutions preparing to allocate in January. That's your buyer base now. And those buyers don't panic over a $4 drop. They see opportunity. The setup for 2026 is perfect. We've cleared the leverage. We've established a high floor. The $78 high we touched today isn't a ceiling. It's a target. The market will go back to see if sellers are still real next time. The sellers won't be there because they sold today. They got shaken out at $74, watched it bounce back, and learned a painful lesson. The path to $100 is clearing. It might take a month. It might take a quarter. But the trajectory is locked. The physics of shortage demand it. This isn't going to be smooth. It's going to be explosive rallies followed by brutal shakeouts each time. Weak hands get eliminated each time. The base gets stronger each time. The next leg up is more powerful. Today was designed to scare you. The shooting star, the violent rejection, the sudden collapse, all engineered to make you doubt yourself, to make you sell at the worst moment. But you held. You survived the shakeout, and in a bull market, survivors get rewarded. The shooting star didn't mark the top. It marked the moment weak hands surrendered and strong hands took control. It marked the transition from easy money to the volatile grind. It marked the end of tourist money and the beginning of institutional accumulation. The bull market is alive. It's angry, and it's just getting started. Welcome to the violence. Welcome to the volatility. This is what it feels like when a decades-long bear market dies and a new era begins. The trend remains intact, and most people don't even know this is happening yet. See you in January. The market rewards survivors, not gamblers. Don't let one shooting star shake you out of the biggest bull market. In precious metals we've seen in over a decade, the journey is just beginning.